Potential market turbulence leading into 2025, followed by euphoria. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, we welcome back Dhruv, who's been continuing his ongoing exploration of where we are in the global cycles, specifically thinking through strategies around when to expect market highs to appear and how we're going to actually action them. How are you going today, Dhruv?
Good, Chris. Thanks for having me back on.
Thank you for that wonderful article that we got actually yesterday, because we're putting this out on Friday. But it was a great article. Again, you've been really following along this story, looking at it through different lenses, looking at it from different angles to talk about these cycles that we're going through and the big picture, what we can sort of expect to see unfold. They're slow moving cycles, but what was really interesting is you also were highlighting in your article some short-term turbulence. So it wasn't just the long-term stuff, but particularly short-term turbulence around the bond market volatility, what we were seeing happening there with global liquidity, and the fact that this could actually lead to a little bit of uncertainty going into 2025. So do you want to start us off there, what you're seeing in that short term, and potentially how investors should be thinking about these scenarios playing out, what they potentially are doing to prepare?
Definitely. The short-term situation right now is very interesting to keep an eye on. We are walking on a little bit of a knife's edge, and that does seem to be the MO where before things turn, they get to the absolute extreme where if they went any further, we'd see some sort of collapse or crisis, and then they tend to turn from that point there. So we are at that crossroads. I don't think it's any reason to be panicking, but it's certainly something to be keeping an eye on. So essentially what's happened is bond yields have been rising steadily since September. The macro trend of bond yields dropping is still intact with lower highs and lower lows. But the uptrend since September, I think, has caught a lot of people off guard. With bond yields rising, you've seen the bond collateral values dropping. This has had a pretty severe impact on global liquidity. We're seeing a lot of headwinds for markets. However, the expectation from this point is that we will be putting in a bit of a midterm top in bond yields, and we can expect that long-term trend of bond yields dropping to continue on. Now, there's a lot of speculation as to why bond yields have been rising. Most people have been talking about how that might have something to do with the election and the election results in America. But I'm quite sure if you look at the economic indicators, it's really nothing to be surprised about. The Fed actually started cutting interest rates in September. That's when the bond yield started rising. The Fed is cutting interest rates in an environment of a strong economy, of low unemployment numbers. And what that does is it creates an expectation of inflation coming in as a result of more loose monetary policy overall. The Fed's mandates are to keep unemployment low and to manage inflation and financial stability. So usually when unemployment's ticking up, they'll relax monetary policy to stimulate the economy a little bit. But what they've done this time is inflation's come down. They're celebrating, saying, hey, we've come and solved the problem, which, as we know, they created in the first place, but they've come and solved the problem. And they're saying, okay, cool, now we can start cutting interest rates, and we're acting proactively instead of reactively. The truth is they are still acting reactively, and cutting into strong economic conditions is getting people prepared for inflation. Now, that's something that is completely expected at this stage of the business cycle. We do expect inflation to come back in. We do expect a wave of liquidity where all markets rise, and inflation is a part of that stage of the business cycle. So it's nothing out of the ordinary. Things are basically on track, but it's just interesting to see that the short-term situation, if it gets pushed too much further with the bond yields continuing to rise and collateral and bond markets dropping, that it could cause some serious systemic issues, especially in the banking sectors.
And it is really important to understand that for people who are watching, because of, like, I know traditionally a lot of people don't pay that much attention to bonds. They go, okay, I don't really understand it. But what we're really talking about here is the rate that people are demanding to take on government debt. So that's what those bond yields are. And when they're pushing higher in this environment, it means that it becomes more expensive to actually fund government debt, because obviously they've got to sell those bonds to the market, and what the market's prepared to pay dictates what the yields are, or what those, the interest rates, if you like, that you're receiving on the bonds. So it is quite interesting to see that here, and against that backdrop of what you were saying, where they're pushing or remaining high when there's Fed cutting going on, normally you'd be expecting them to fall a little bit. It probably is an indication that people are concerned about inflation on the horizon. I mean, certainly that makes logical sense as an interpretation. Do you think that it potentially shortens? I mean, you're implying there that inflation is natural at this part of the cycle, but is the Fed going to get it wrong as it often does and continue cutting into a rising inflation environment, or do you think they change the policy this time and potentially stop cutting rates a lot sooner?
I think given the overall cycle and where we are, regardless of what the Fed does in the immediate term, I think the rate cutting cycle is well and truly in play at this point.
Mm.
So whether they at the next meeting pause or do smaller rate cuts, or whether they go really aggressive with it, the speed of the rate cutting cycle is yet to be seen. But what we do know is that the rate cutting cycle has started, and like we discussed, that is very much part of this stage of the business cycle. So seeing interest rates falling off, seeing bond collateral values increasing with bond yields falling off, seeing liquidity flooding into the system is very much expected, and inflation is just a natural consequence of that. Inflation has been around since we went off the gold standard in a big way, and it's not going away. So to expect another round of inflation, just given what we've just gone through recently, I think is reasonable. And I think regardless of what the Fed does in the immediate term, we can look forward to the next couple of years and expect inflation to come back in a significant way.
And how does this tie in? Because you've mentioned before the winner's curse, right? This is a concept that you've really introduced us to here over the last few of these presentations, discussions, where you've got that period of absolute euphoria, but leading into something else. Do you think that we are obviously inching closer to that, over time, getting closer to that period unfolding? What do we need to be looking at right here? Because they're still slow to unfold. It's not like you're saying that anything's going to happen tomorrow. You're saying it happens still a little bit ahead. What are we looking for here? What should we be paying attention to?
Yeah, that's a really good question. So the way it ties in all together, it's actually quite interesting to see it unfolding in real time, because you have these expectations of how these cycles are going to play out, and quite often you don't know exactly what's going to be the specific factors that lead to the cycle moving forward. And when you see them unfolding in real time, it's very interesting. So with a rate cutting cycle, an increase in liquidity, you'd expect the winner's curse phase to really kick off. You'd see most assets rising together. So you get asset inflation. Generally, there's a bit of a lag, but then you see consumer inflation in your day-to-day lives as well. Now, what that would lead to logically is a rate cutting cycle. Sorry, a rate hiking cycle. Forgive me. So the Fed would then tighten monetary policy as a response to consumer price inflation increasing. And what that means at that point is you've seen a phase where there's been a lot of liquidity, assets have been rising together. That leads to the greed and the complacency. Then you see consumer price inflation coming in, and the Fed responds to that reactively by going on another round of interest rate hikes. What does that lead to? Well, logically, you've got then bond collaterals falling off in value, because bond yields will probably lead that cycle. So you've got bond yields going up in a long-term trend. You've got bond collaterals falling off. And then you've got interest in the private debt sector being high as well. So what are the ramifications of that? Well, if banks hold bonds as their blue chip collateral, how resilient is the banking sector to withstand another round of interest rate hikes? If you see bond yields going up and bond collaterals falling off, and the balance sheet of most private banks looking more and more unhealthy, are the private banks going to withstand that? Now, we saw a little taste of this in the previous round of interest rate hikes, where we saw the Silicon Valley Bank collapse. We've had a few other smaller banks collapse in the meantime as well, but that's really no longer in the headlines anymore. If we see another big round of that, do we see this on a larger scale? Now, how resilient is the land sector to another round of interest rate hikes? With the 18.6-year cycle, it really is a land cycle. So what you're expecting after the winner's curse is a secular land recession. So how resilient are homeowners with mortgages to another round of interest rate hikes? What does that do to um, the property sector? How resilient are commercial real estate owners that have bought investment properties that since the pandemic have been yielding pretty dismal rental returns? If they've got to hold these commercial properties for another multiple years of high interest rates, do they just start selling? If there's a flood of supply on the market, what does that do to commercial real estate? And then to tie it all back in, how exposed are the banks to the real estate sector? So if you see banks looking unhealthy on their balance sheet, and you see real estate going through a secular recession with commercial real estate and homeowners, home values dropping, land values dropping, how exposed are the banks to that? So what we would expect in the recession phase of the 18.6-year cycle is systemic, broad-based financial collapses and breaks in the system. So another round of inflation leading to another round of interest rate hikes would make a lot of sense as the catalyst that leads us from the winner's curse phase into the systemic collapse phase that follows.
And I really just want to touch a little bit more on a point you made there about the bank's exposure to property. I mean, we know I was having an interesting conversation the other day with somebody, I can't remember who I was speaking to about it, but talking about gold and silver specifically and saying how it was fascinating to me that banks would take on property as collateral, but wouldn't take gold. You couldn't just go to the bank with your gold bullion and say, here it is, this is my collateral, I want to borrow money against it. They would look at you strange or not understand or just simply wouldn't do it. And when you look at it's so ingrained, this idea that property prices just never go down. They're always up and to the right, and that you can base all sorts of debt on top of it, that it really could create massive problems. We saw a glimpse of that with commercial property during the crisis that you're mentioning, so that we were experiencing into last year, where you really had those small banks being very concerned about what was going to happen with commercial real estate. That all seemed to disappear. We didn't really hear much about it again, but I don't think those problems have been fixed. I think that's still the case. I mean, looking around the city, that's the case still, that a lot of places haven't returned to full occupancy. So there's going to be problems down the line. But yeah, it's a very interesting point, I think, this idea that the rate cycle impacting the land cycle could have really significant consequences.
Absolutely. I'd love to see a future where we're able to leverage precious metals into getting debt of something that's a little bit more stable than land markets that inevitably every 20 years will go through a massive secular recession. And in Australia in particular, the Aussie banks are massively overexposed to both commercial and private home ownership. The interesting things about commercial real estate is that like you mentioned, you really do see it. The occupancy levels in the CBDs are at an all-time low. You've got investors that are just holding on to these properties, hoping for things to change, saying, okay, well, interest rates have finally gone down. We can breathe a sigh of relief. A lot of them will probably refinance into fixed mortgages, but it's really interesting to see what's going to happen in the next 4 to 5 years with land. And you hear this anecdotally with tradespeople, HVAC, specialists, electricians, and all sorts of people that work in the city on these buildings, and they're walking around saying it's basically a bit of a ghost town compared to what it used to be. So, writing's on the wall. Obviously, nothing's for certain, but we'll see how these things play out over the next couple of years.
And the last question, you talk obviously a lot about gold and silver. That's what we talk about, but you tend to highlight when you're discussing these cycles, the resilience of those assets during that euphoria stage, but also during the collapse, which seems to be the best of both worlds. I mean, some people will probably be skeptical of that and say, well, hang on, you can't have something that's the best of both worlds there. Obviously, if it's going up in the euphoria stage, it's going to be smacked down in the collapse phase. You believe you can get the best of both worlds there. Do you just want to sort of wrap us up today with a little bit of discussion around everything we've talked about here, how that ties in with gold and silver?
Definitely. The interesting thing about both gold and silver is that they benefit from increased liquidity in the system. So if the currency is losing value because there's more supply of the currency, aka, more increased liquidity, the asset price the hard asset priced in that currency will by default, even if demand remains constant, will increase in value.
Mm.
So the phase leading into it, you might see risk markets outperform safe haven markets like precious metals in the short term during the winner's curse phase. But you see precious metals markets still continuing to increase in value. It's not that they're declining in value, but everyone wants the maximum yield. When there's a lot of greed around, people are not going to want a 10 to 20% return when they can get a 30 or 40% return. So what happens then is these other risk markets get over leveraged. When you get into the collapse phase that follows, for a very short period of time, everything goes down to varying degrees because
Mm.
everyone's just selling what they can to cover themselves. But risk markets go down to a much greater extent than things that have gone up less in the phase prior. But then straight after the collapse phase, you see these risk markets just struggling for years and years to even recover to their previous highs. But gold and silver during this time become the assets of choice, and they very quickly recover from that short dip and continue on to put in new highs after new highs for years and years to come. We can pull up a chart of the global financial crisis, which was the most recent example of this, and you can see how the S&P performed in relation to gold. And the reason for this is because once the collapse happens, you start seeing other markets struggle and you see precious metals continuing to put in new high after new high. Speculation starts to enter the space, and people are looking for growth in whatever asset they can find. Gold and silver, particularly, have been outperforming. And so you start seeing a lot of new investors coming into the space. This is where silver actually outperforms in a massive way. It really shines because once speculation enters the space, you're looking at an asset between gold and silver, where silver has a much smaller market cap, much lower liquidity. So the same amount of money entering the silver space causes pretty significant rises in price compared to gold. So silver starts outperforming gold. And what that means is the gold to silver ratio actually falls off. So again, we can look at a chart of this as well. But in the GFC, just during the crisis, the gold to silver ratio shot up for a very brief period, just a couple of months, and then dropped from I think about 85 to about 35. So it got chopped in half. This is where silver went on a very strong run against the dollar and was outperforming gold in a big way. This is the global financial crisis, which is the most recent 18.6-year cycle. I'll just quickly say as well, we do happen to be coming to the end of a 8-year cycle. And the last time this was the case was the Great Depression. So really that is the reference point more than anything else, I think. And what the gold to silver ratio did at that phase is really interesting because it dropped off from the 80 to 90 level to sub 20. Now, this took a while to play out, but silver went on a long-term secular bull run, multi-decades, leading from the previous fourth turning to the first turning. So after World War II into the 50s and the 60s, you saw precious metals really go front and center. And that's basically where we are right now as well. So you can try to navigate a very tricky market setup across other assets. That's certainly an option. But for people that don't want to be looking at charts day in and day out and take all that extra risk, gold and silver provide a vehicle that's really straightforward. You can get into silver when the gold to silver ratio is high, trade it for gold when that ratio falls off. So you've got incredible capital gains. You've also got shelter from the storm, or an even simpler set and forget strategy is to just buy gold and don't worry about it because there's never really a bad time to buy gold in terms of really macro perspective. But if you're looking at a multi-decade bull run, you can get your shelter from the storm, your stability, and your capital growth by buying gold. That being said, I'm probably way too excited about silver right now to suggest that strategy. So, if we have a chart of the gold to silver ratio and the silver price around the previous fourth turning, which is the Great Depression on screen, I think that'll make the case pretty strongly for buying silver and trading it in for gold down the track.
And that's certainly what you've done with me. The more you show me that chart, I've been over the last few weeks really selling a bit of gold, moving it into silver. Just I can't ignore what you've shown me in those charts. It's pretty compelling. So yeah, I'd probably say to everyone, pay a bit of attention there, particularly if you like I tend to be pretty much gold only, but when you when you see that, you can't help but need to load up on some silver as well. So very compelling stuff. A great deep dive, as usual. And really, thank you for just continuing to take us on this journey of understanding so we really understand what's driving all this. It's really valuable. I think everyone appreciates it. So thank you for that, Drew.
Thanks, Chris. Great to chat to you. Talk to you soon.
Great to chat to you. Thanks everyone for watching. We'll chat again soon.